Well, from airlines to the broader economy, and the Reserve Bank tomorrow makes an interest rate decision, with money markets now saying there's a 1 in 3 chance that rates go up. Among market economists, 10 out of 30 say there will be a rise, about the same odds. Now, one of those is independent economist Warren Hogan, a consultant for the small business lender Judo Bank, who joins me now. Warren, do they have any alternative but to put the rates up tomorrow?
Well, they could, but I think what we've seen in the past few weeks, particularly with the Senate estimates appearance from the governor, is they're thinking the cash rate's got to get over 4, probably more like 4.35. The question would be, why wait? The sooner you do these things, the less chance you have of getting behind the game. So I think tomorrow's as good a time as any, if they're now sort of the view that they've got to get the rate up further. They may wait. They may not want to send such a strong signal after the budget, after the Fair Work Commission decision, but I think on balance they'll probably go.
But you can see from here on Friday just that big jump in the expectations of a rate rise coming. And that was off the back of that Fair Work decision. Yep. And the fact that some workers getting more than 8.5% pay rise, the vast majority getting to 5.85%.
I think the momentum was building with the Senate estimates appearance on Tuesday, and then the Fair Work Commission decision, I think, was what got a lot of people.
And then the monthly inflation indicator came out in the middle of that as well.
Of course, and that was, I think, also very important. I mean, it's all pointing to a basic fact, and that is the economy's not slowing enough. Inflation's not coming down enough. In fact, it's showing signs of stickiness. And of course, this all lends to the view that the cash rate's got to be higher, where the job is not done. So get the job done now. We've seen a lot of different evidence, whether it be from indicators of activity or whether it be the monthly CPI. We saw the TD Melbourne Institute inflation gauge today further reaffirm this idea that inflation's sticky, that it's not coming down quick enough. So I think that it's a matter of getting ahead of it.
But you talked about inflation in the services industry in particular, and that's one indication. But there's more indication that that whole services sector, it is starting to slow, but perhaps not as quickly as you might anticipate.
Well, what we're seeing, the Judo Bank Standard & Poor's, this is the PMI that came out today for May. It was slowing last year from extraordinarily strong rates of growth. We thought the plan was coming through, soft landing, and then in the last 4 months, it's picked up again, as you can see there. May was actually down just a little bit for business activity, but firmly in expansion territory. New businesses picking up to the highest level since last year. So the manufacturing sector's slowing, but the services sector's picking up again. And of course, that's 85% of the economy. That's what matters. And of course, that's the inflation the RBA is worried about. Last week, we got Australia Post prices up 10%. Yeah. We know electricity prices are going up 20% on 1 July. There's just more evidence.
The New South Wales government putting up wages.
4.5% today.
Yes.
Yeah. I mean, it's all too much inflation for the target. And I think it suggests that the 3.85% cash rate is not going to get the job done. You look overseas, the US is debating whether to go to 5.5% next week. New Zealand's already there. UK and Canada at 4.5% already. The RBA's got work to do.
Yeah, OK. So final thing is, what are they looking at right now, do you think? What's the last thing that they're looking at as they're making their decisions?
Look, I think the argument the governor put forward last week that wages at 3.7%, the last wage price index, is fine, but that assumes we're going to get some productivity growth. And they're thinking 1% is the number to assume. And of course, if we get that, that's fine. But if we don't, we see that wage growth just translates straight through into inflation. Unit labour costs are rising. This chart here shows you 7% as of December. We'll get an update with the national accounts on Wednesday. And that's really highly related to inflation in the economy. So without any productivity growth, even 4% wage growth is too high for the target. And of course, whether it be the New South Wales government today, the Fair Work Commission on Friday, the signal coming out of the labour market is wages growth is going up.
OK, so that being the case, that's the grave fear, because as soon as that wages growth goes up, trying to chase inflation, that is your wage price spiral that people talk about, that the Reserve Bank Governor, Philip Lowe, has worried about. And yet there's evidence now that maybe it's starting to evolve into that type of thing because they haven't gone hard enough.
Yeah, well, the only way you're going to stop wage claims of 5% being successful is if the economy is slowing down, if there's some pressure on business not to be able to pay that. And of course, at the moment, the evidence is the economy hasn't slowed enough and that they are paying higher wages and they are passing that on in inflation. So it all points to the same thing, and that is that they've got to put rates up some more.